Well, it's
Hey,
recording right now, so
it is recording right now. So, hey, how you doing today?
I'm doing fantastic. You told me that we needed to do something and talk about strategies, so let's get into it.
Let's get into it. So, you've had some interesting people that you've talked to this week, and that's kind of one of the reasons why I thought it would be good to put this together. So, let's kick it off. Give me a scenario that somebody's come to you with, and let's kind of talk through it and talk about what that looks like, maybe before and after.
Okay, I guess the first one that we could really start off with, it's kind of easy and the numbers are just there. A guy has a construction company
Okay.
and he had a tax bill because he not only does construction and remodels and stuff, but he also flips homes. So there was that component as part of it. And his tax bill was, about $150,000.
That's
And he was
substantial.
like, he was like,
Probably
that's
less than excited about it.
yeah, he's like, I'm working my butt off and building my company and out there in the industry, and I'm having a good success, and I'm generating success, and that's making more successes. But then I get hit with this, and it's like it's gonna destroy my cash flow. So I decided to reach out to a professional and see what can be done. So I went through and I looked at his numbers, and the first thing I noted is that, like, in truth, like, his bookkeeping from the basics weren't necessarily where they should have been.
Okay.
He wasn't capturing all of his business related expenses that he, as an employee of his own company, um, he also wasn't capturing expenses because he was paying for certain things out of pocket, thinking that he couldn't write them off as business expenses. So we corrected those two things first. And then we started diving in. So once we got past the bookkeeping, we started diving in to, like, his assets and depreciating his assets and how to go about depreciating those assets. Like, so we started building it out. I mean, literally from the ground up, even though he had already been in business now for, at, at this point, it was 2 years. He hadn't had anybody from the beginning tell him how to, do his books. He kind of did it by Google or DuckDuckGo education, QuickBooks Online startup kind of a thing.
Sure.
And then his assets weren't properly recorded because no one told him how or how to go about it or what to do about it. And then the structure within his business was such that he didn't take advantage of things like tax credits that were available to him. And so we hit all of these different areas. And once we restructured everything and ran the numbers again and used the same format that his previous tax preparer had done for him. And it came out that instead of 150,000, no, mind you, this is a nice round number, but it was like 157,000 and change, right?
Okay.
The number dropped down to 88,000 and change.
That's huge.
And it was really big. And he was like, how is this even possible? I said, look, the IRS never tells you when you made an error in not including a deduction.
Right. They're not going to call you and say, "Oh, I think, sir, business owner or ma'am, business owner, you missed a deduction."
Right. And so, like, and the biggest thing was is that, like, his personally owned assets that he was now using for the company and the company was paying for and stuff, he never transferred that asset from in the sphere of his personal to then selling it to the company and having it become a company asset that can then be depreciated by the company.
So you're
And
talking about, it sounds like two quick things that you did without really even having to do anything that had been kind of missed or neglected by his previous tax professional.
correct. And some of those things came down to, like, he is in California, and he at the time he didn't have a retirement plan set up within his company structure. And I'm like, well, first and foremost, that's a requirement in the state of California, but also there's a provision that you can get tax credits for having a retirement plan.
Okay.
And he's like, well, I didn't know any of that. So, we set one of those up quickly, and he was able to then pay for a retirement plan, take profits out of his company, by being an employee, but also as the employer, and put profits into a 401k structure. And the company got to write that stuff off. He got to get tax credits for having that plan that he needed to have anyways. And all of that started, like, these things like stack on top of each other. You get $1,000 here, $2,000 here, and before you know it, after 10 or 15 different things getting stacked on top of each other, he was looking at, a tax liability reduced from 150 to 88,000.
Well, it's really from 160 to 88,000, but you can call it 150. Sure.
Right. So the biggest thing is that, like, he had all of these assets, this equipment that he had owned beforehand that now the company was using, and the company was paying for, but yet he at the time was still the owner of it. And I'm like, no, it needs to be owned by the corporation. Like, the corporation needs to own it, needs to essentially buy it from you. And then once it did that, and we processed through all of that, we depreciated that all out. So he went from having, all of these deductions, and then we increased those deductions through this process. And when you get a bunch of deductions, it reduces your taxable liability based on your tax bracket, because an S corp is a pass-through entity. So if the S corp has 200,000 in profit, and you're in the 22% tax bracket, that's simple math. $44,000 in taxable liability.
So just to pause you for a second, because I know there's a lot of technical things we're talking about, and I just kind of want to highlight the three different tax strategies that you're mentioning. So the first one, or I would say the highest level one that you're mentioning, is the benefit and the advantages of an S corp and how that can affect taxes. The second one is depreciation. And of course, the depreciation and your depreciation schedule being tracked and categorized correctly can absolutely affect your tax liability. And then the third one is that retirement plan. So that 401k, I believe, is what you said. So those three things, just those three things, cut his tax bill. I mean, honestly, it cut his tax bill almost in half. I mean, I'm not sure exactly what the percentage is, but to go from $160,000, sorry, 157,000, but 157,000 down to 88,000, that's huge.
Right. And so by having that change, it completely changed the direction that his business was going. Because he then realized that then he had so much more that he could be putting into his business and developing his business. And then he actually started a second business that then had synergy and worked with his first business. And then that increased his taxable liability, or that decreased his taxable liability by increasing his business expenditures, but he was paying for things that he wanted to do, right? So he wanted to, take a trip, but how to make it a business trip. So we walked through that. So, I mean, there's lots of different things that you can do on an individual transaction basis to ensure that the business can then write it off, versus it's something that's coming out of your pocket. You'd much rather it have come out of the company's pocket, but you have to do it right. You have to do it the legal way, and you have to do it following the code,
Of course,
the tax code.
the legal way is super important. We're never going to be encouraging people to we actually really aren't ever encouraging people to even bend the rules, let alone to break the rules or do anything that's, against the law. We're simply applying the different tax codes to a business owner's individual situation so that they can maximize their tax savings. But one thing that I do think, or I guess I should say another thing that I do think that's worth mentioning, is a huge question, and I hear it on almost every single call that you take, is why didn't my previous tax person do this or tell me about this, or, why have they failed me? And it becomes kind of a tricky question for us to answer because we never want to throw another professional under the bus. But there is a problem, we'll say, in the bedside manner of traditional tax preparers.
I would say it comes down to three main components. The first one is that like people talk about CPAs. CPAs in regards to taxes, that's not one of their primary sources of income. For most of them, that's not their primary source of income. They make money doing so many other things in the realm of being a CPA that taxes is just kind of something that they have to do as a baseline,
Sure,
right, for
like
their clientele.
certified financial audits, things along those lines. Absolutely.
Right. And then the second part is it's not a focus of education. The focus of education for a lot of tax preparers is how to take the data that you provide them and put it onto the form and then give you back that form using the data that you provided to them. You review it with them or without them, and you sign off on it, and then it gets filed,
Right.
right?
And
And
that's,
then
I
you're
mean, that's absolutely without a question my favorite soapbox to get on, right? Like the tax system is rigged, but it really is because you're putting the responsibility, or at least traditionally what tax preparers have done is they've put the responsibility on the client who has at best we'll call it duck duck go education on taxes and what they can, deduct. And then you're saying, okay, give us the information, and they don't really poke and they don't really prod and they don't ask those questions. I think one of the other reasons why they're not asking those questions is that most tax firms, in order to in order to cover their overhead, whether it be employee overhead or office overhead, they are having to do 2 to 3,000 returns in a calendar year. I mean, their client roster is huge and deep. And when you're dealing with that many clients in such a short time frame, it's hard to take the time or hard to justify taking the time to really dig deeper with clients.
very much so. And so one of the things I do is I dig into not only as I stated earlier, we get into the books. I'd be like, so who pays for this? How does this get paid for? Does the company do this for its employees? Does the company do this for its board members? How is that tracked? How is that, essentially who's paying for what is kind of what it comes down to. And when you talk to a normal tax preparer, generally you don't talk to them outside of tax season. So they don't necessarily have the time to then track where all of their clients are at and then give them all of this strategy advice outside of the buy a new truck if you're a
Yep.
construction company,
The
or if
great
you're a real
spend
estate
more
agent,
strategy.
right? Buy a vehicle, right? Buy a vehicle is another one. Buy new equipment. Well, all of that requires you to spend money to then save money, but the money that you're saving is not equal to what you spend, right? So
Right.
if you go and buy $100,000 vehicle, that means the business spent another $100,000. That's $100,000 in expenditures, using 100% depreciation. You save what your tax bracket is. So if you're in the 22% tax bracket, you've saved $22,000 in liability
Right. So you
for
spent a
spending
hundred
a hundred
thousand
thousand.
dollars. The math
Right.
doesn't math.
So is the trade-off there? Not necessarily, right? But is it in the business best interest to buy the vehicle? Then that's when it really starts to make sense. Buying something just because you were advised to do it because it reduces your taxes isn't necessarily a good business decision. Because what if the business doesn't need it? Well, then there's other areas to look for potential deductions for the business and actually have it be something that is sustained and long term.
Absolutely. So let's get back to this client with this, $157,000 tax bill that you were able to, with And I'm going to guess, just from knowing and working alongside with you as many years as I have, that those three tax strategies were just kind of the tip of the iceberg on where you went. So I'd love to hear more about how you went further with them. But just those three things, the S Corp and maximizing the S Corp, the 401k, and the deductions from the depreciation reduced the tax liability, just right there, reduced the tax liability by $69,000. Now I could call it 70, but we're going to call it 69,000 since we're using real numbers.
So one of the things that we brought into it is because he's not only the solo employee, but he's also the primary shareholder of 100% value of the corporation. And we hired his kids, but we hired his kids as models for his business for him to do his social media marketing and also his print marketing and other marketing ideas that he had. So then he was then paying his children a wage to then help his business, and the business got to write off the value of that. Right. So we employed his children. We also, used the Augusta rule, right? So the Augusta rule is something that has scalability and has sustainability along with it. Because eventually kids do grow up,
They
right? So
do.
it's
They do.
great to
They
use
age
during
out.
the, right? They age out, right? But you the Augusta rule is something that you can put into play for your corporation that then is sustainable. And depending upon how you use the Augusta rule, it has scalability to it, right? So it could be something where you're writing off, you know, in the earlier years of the business, you're writing off, five to $10,000, and then as the business grows, and you're in year 10, and you've hired additional employees, you've expanded, you've got a commercial office and stuff like that maybe you own the building now. You now then use the Augusta rule for 20,000 or $30,000 on annual.
And
And all of that means is that it's less money coming out of your pocket
right.
to then pay on taxable liability. And if you keep money in your pocket, then that means that you then as an individual can do more things that you want to do, but then also your company has more liquidity for the potential to expand its operations and or retool its operations for greater efficiencies.
Well, and one of my favorite things about the Augusta rule, it's probably one of my favorite tax strategies, not only because I think it's one that a lot of people don't really understand, but I think it's also something that you should be doing anyway for your business. You should be having regular meetings with your team. You should be having regular meetings with your clients. So it works in the support factor of your business to help your business grow, but it's also using something that you most likely are already spending money on and being able to use it to your own advantage to maximize the tax savings.
Correct. And with each one of these, it's something that it continues on every year. So this isn't just a one-time thing. I mean, once you put a tax strategy into place and you've updated your policies and procedures for your company to reflect those changes, then that's something that is sustained as long as you have the company or the company has the means to afford these strategies. And what I mean by afford these strategies, it means as long as the company's continuing to make money, you can still implement these strategies, right? So even if you had to take a step back from your business and the development of your business because of health issues, family health issues, or something else, those plans still stay into place. And then once you're ready to pick back up the mantle and continue forward with your business, it's already there. So this isn't something that goes away because you had to step away for 6 months, or this isn't something that goes away because you were working for yourself and someone came along and gave you an incredible, 12-month employment offer and you went and did that for 12 months and now you're back doing your own business. All of that stuff's still in play. All of that stuff is still there,
Kind
right?
of
So it
running in the
has flexibility
background,
as well.
right? So did you use the Augusta rule with this particular client?
Oh, I certainly did.
I love that.
Because he's in construction and he has a lot of guys that are contractors that work for him, and he enjoys having barbecues and get-togethers with these guys that he grew up in the industry and worked along with, and now he's doing his own thing, and he's hiring these individuals to do jobs for him. And I said, well, what did you do? And he said, well, I like to have a big Fourth of July party. I have barbecue and I invite all of my contractors over, which are my friends, and I invite their families, and I got my family there and stuff like that. And I said, well, did the business pay for that? And why not? And he's like, well, what do you mean? I
Can
said,
I
did the
tell you my
business pay
favorite
for that?
part about the Augusta rule? And my favorite part about the Augusta rule is it has certainly filled up our calendar, our social calendar. We've been getting invited to all of these events and all of these parties.
That is true. We get a fair number of invites, and I do apologize to my clients that are in other states that we can't make it to those events. They really do sound like a lot of fun, like luau's and stuff like that.
Absolutely.
One of them was having had a massive paintball party. I mean, I would have loved to have gone to that. He
Yep,
had from what he told me, he had 75 people out there with paintball guns having a fantastic day,
that's
right?
terrific.
And it was a company event, right? The company sponsored it. The company was at the core the reason why that the event was going to happen, right? And so then the company then became responsible and happily paid for the expenditures for that event. And he had the event at his house, and he had a ton of land, and there were a ton of people there. So I mean, we worked up um, the justifications for the Augusta rule usage. And then now that has become something that he templates and he does regularly throughout the year.
Right,
He
rinse and
tries,
repeat.
yeah, rinse and repeat. He tries to have, with every season change, he tries to have a major event that his business invites clients, invites contractors, and has potential clients that get invited. Contractors say, "Hey, I think you want to start working with this person. Hey, let's invite them." It turns into a great big meet and greet, and he generates so much additional business from those events. So not only does he get to have a fantastic party, but the company pays for it, and the expenditures for the company gets to write it off, and all that fun stuff related to that. But he also generates business from it.
Correct.
Like without fail, since he started doing and using these systems and changing the policies and procedures within his corporation, he has seen not only a lot in regards to tax savings, but because there's a kind of a business coaching component to it, he's also developed his company that his revenue has gone up on average 13% every year since he started working with me.
I love that. So tax liability is going down, income's going up. That's terrific. So he's implemented the corporation strategy. He's implemented the depreciation strategy. He implemented the retirement plan, which is legally required in California. I'm not sure if there's other states that it's legally required in because I'm not the tax girl. I just help with the tax guy. And, he's, of course, hired his kids, legitimately hired his kids
Legitimately
to
hired his kids,
do
and
things within the
also
business.
he also opened up savings accounts in his kids' names that he's funding and saving for giving them a fantastic nest egg that is growing in the marketplace. So when they turn 18, they have something that then they can go and they can go open up their own business. They can go and have a significant down payment for a house.
Yep.
Maybe they're going to go off to a university and stay. Freshman year they stay at the dorms, but sophomore year they go and buy a house.
Right.
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 So all of these have opened up additional options for not only him but also his family. And all of it started with that he randomly was searching and came across our podcast and it just went from there.
It did just go from there, but the last thing that you're implementing with him is the Augusta rules. So you're helping him to roll that out correctly, I would say, because that is one that there can be a little bit of scrutiny around. There's a lot of people that have a lot of questions about it. I've had some passionate debates with other tax professionals about it. And really, what it all comes down to is the documentation. And I honestly think we could do a whole episode on just the Augusta rule, especially if we could have, like a whiteboard or something like that in the background, because I think it's a really visual thing for some people to understand. So with those five things, corporation, depreciation, retirement plan, hiring his kids, and the Augusta rule, that took his tax liability from $157,000 down to what was the kind of the ending amount?
88,000.
To 88,000. So that's pretty incredible. I mean, a $70,000 savings in taxes. Now, of course, tax strategies, like I said before, are a totally and completely personal thing. There are so many different intricacies to everyone's, tax situation. Our tax situations are truly as unique as our fingerprints, right? Like no two people, even if they're in the same business, are going to have the exact same tax situations. It's just not possible. So that is why it does take, I believe, the personal approach to be able to truly develop a tax strategy for somebody. I think that of course, scheduling a call is going to be my top recommendation, right? But no, that wasn't really my point. I was going somewhere with it, but I guess I lost where I was going. But I'm still blown away by the $70,000 in tax savings. $70,000. That's huge. That's huge.
That is. And one of the things that I think many people don't realize is that you can still keep your same tax person. Like you don't have to become a tax client of mine specifically to enjoy the benefits of introducing policies and procedures within your corporation that save you money. Because ultimately what we're doing is doing things that are within the company structure that then you then provide a profit and loss statement with records to your tax person. The tax person then takes those numbers, as I talked about earlier, puts it onto the forms, gives you back the forms, you sign off on them, and you have a great big smile because your taxable liability just took a nosedive.
Sure.
And it took a nosedive legally because no one ever really tells you, especially the IRS, and I'm not necessarily making a dig at the IRS. I'm just saying that's not in their operating procedure to call up someone and say, "Hey, we noticed last year you did a mileage deduction, but this year you didn't.
No,
Can
because
you?"
we
Right.
operate on a self-reported system of taxes. So that isn't in their purview. That's not their job. Their job is to make sure that you are paying your fair share in taxes on the amount that you are reporting or that is being reported on your behalf in taxes. And it's really that simple. Um, a good point I think to make is when is the best time for somebody to work with you or to work with a strategist? Of course I know the answer, but
In the year that you want it to be effective.
okay, so explain that a little bit more because I
So
think that's huge.
if you want, if like your last tax bill was huge and you're looking to make a change because of that, then start sooner rather than later because the IRS has a really difficult time with people going back in time, right? I mean, you can, of course, if you have reasons to amend your filings, you certainly can. But instituting new policies and procedures doesn't necessarily trigger the reasoning to then do an amended filing, right? So the IRS doesn't want you going back in time. You need to do it now rather than wait. And the reason why I say do it now rather than wait is because if you want your 2025 taxable liability to be reduced, then you need to do something in 2025. You can't wait until 2026. You can't wait until 2027 to affect something that's right now, right? And if you want to do something right now, you certainly can and have that come into play and still keep your tax person if you want to. Or if you want to try someone different because you're not getting the level of service that you would like, you're not getting the responsiveness that you would like, whatever your reasoning is, it's your business and you're justified in having those reasons. So move forward and find someone that will help you, whether it's us, whether it's someone else. Just reach out there. And I will say this in regards to Google, DuckDuckGo, X, um, Instagram,
Well, let's
TikTok,
add AI into the mix
and
as
AI.
well.
They will tell you that something is possible, but they won't necessarily tell you how to do it and how to do it legally.
Right. And
And those that's kind of a key thing,
how to make
right?
sure all your I's are dotted and your T's are crossed and that you have the proper documentation. Now, is there anything that can be done for someone who paid, a ridiculous amount in taxes in, let's say, 2024, because we're now going into the 2025 year? Well, we're actually just about to approach the end of 2025, but is there something that you can recommend for somebody who has had a huge tax liability that they've already paid on, or do you really recommend that they leave it alone and they move forward? And I understand that that's a loaded question, but I'll say asking for a friend. How about that?
So if you had a high liability in 2024 and we're now in 2025 and you want to do something about that 24, the first place I would say is you need to look at your assets and you need to look at your books because almost every time I go through someone's books, I find expenditures that are missing. Or I find the fact that they have assets that never got depreciated. Like the company has owned them from day one and never was depreciated. That's an issue,
So I
right? So
think I
essentially, those items have been on the depreciation schedule, but no one took advantage of it. So literally, you were renting the equipment from yourself to your business for zero money every year.
I mean, I think if we do the math, it was like 44% that you saved the person that we were talking about off of their tax liability. There was nothing necessarily wrong that their previous tax person was doing. They just weren't digging as much. One of the things that I really would like to highlight that you do that I think is incredibly impressive, there's a variety of things, of course, that I could say you're so impressive about. But one of the things that I do think that you do or that you offer is that you will look at previous years and you will kind of run a, I don't know what it would be called, but you'll see if the cost for them to have you redo it with tax strategies that can be done retroactively is worth it for them to dig into a previous year, and you'll give them a very honest answer. I mean, I've heard you talk to people who are like, let's do it, let's go back 3 years, it's worth it. And you're like, well, really it's only a gain of, this much. And then of course the choice is up to them if they want to go back like that. So I just want to make it clear to anybody who may be watching that we're not in the business of pushing people to do things that aren't in their best interest. And with previously filed taxes, we will really run a risk assessment, I guess you could call it, to be able to let them decide for themselves what makes the most sense.
Right. Because
Um,
ultimately, you're the one responsible for your taxable liabilities.
well, and I
Like,
think that's a huge point as well.
right. Your CPA is not the one that's necessarily responsible. Your H&R Block tax preparer is not the one that your local shop is not the one that is necessarily responsible because they rely on data and documentation that you provide them.
Right.
Right. So ultimately, the decision on what you do with your taxes, what you do with your corporation, what you do with your money is essentially up to you. And the best thing I can do is give you the pros and cons for making that choice and say, like, okay, if you do this, it's worth it because of X, Y. But you do run the possibility or an issue in regards to Z. And we talk through it. And then if we can then take the cons and provide documentation and reasonings for, and we can then eliminate those as cons, then it's a win-win situation. So when you do something like an amending return, you have to have a reason. And a biggest reason that I find with a lot of my clients is that their books weren't done. They weren't done, I don't want to say correctly. They weren't done with the level of
Diligence. It's
attention to detail and
diligence. Yeah.
diligence. Diligence,
I mean,
yes.
and on the bookkeeping side of things, which this is totally not about, but on the bookkeeping side of things, we'll get pushback from clients because we dig on things and, but we dig on those things because we're looking at the bigger picture. We don't dig on things or push on things because we want to be annoying or irritate our clients. So I'm going to guess that our timer is about to abruptly end us. So I think we'll wrap it up at that, but that's 5 strategies that you used with one client. You take the time to work with your clients throughout the year while the events are happening, while there can still be an effect or a change that has impact on that tax liability for that coming year. And I think that all of those things together make it a huge impact. I mean, this one client alone, a 44% reduction in taxes. That's freaking incredible in my opinion. So, and that's pretty true of what we see. You will generally not
Generally,
take.
we see anywhere between 20 to 30%.
Right. And you will,
Right.
well, I think it's higher than that, but okay. So we'll say 20 to 30%, which I call baloney on, but that's fine. Um, but
I
you,
want to start with reasonable and good expectations and then get above and beyond that after the fact.
well, but often what I hear is you having the conversation with someone who, if they're at that 30%, of really finding out if it's worth it to them to put the work in, to take the time to have the calls with you throughout the year before they commit to it, because it's a commitment that goes on both sides, right? It's a commitment that of course you as the tax professional are committed to having those meetings with them, but they also have to be committed to doing the work and following the directions as prescribed, so to speak. So well, I mean, as
All
always,
correct.
I love it when you tell me I'm correct. So as always, it is fantastic to talk to you, and I think we
Oh,
will
such a pleasure to
wrap
talk
it
to you
up.
as well.
I know it's
I'll
crazy.
see
It's
you at dinner.
crazy. I'll see you at dinner. Give us a cheers.
Cheers.